let's take a look at what's happening with ITC. And this is a very interesting, very detailed note from the house of Morgan Stanley. So let's break down what has happened. First, they've maintained their equal weight rating on the stock with a target price of 346 rupees per share, which is still about a 19 to 20% upside to where the stock is trading right now. They say that the cigarette industry has seen its steepest one-time tax increase of 40% effective 1st of February. And so far, to combat this, ITC has adopted a more staggered approach to price increases. Morgan Stanley's channel check suggests that company has undertaken price hikes anywhere between 20 and 40% across different categories, but the higher price hikes have been seen in the premium categories, and they've also introduced shorter cigarette lengths offerings to protect their volumes. Now the key question is, what next in terms of realizations versus volumes versus pricing? What is ITC going to prioritize? Let's take a look at the first scenario where ITC continues to go ahead with its staggered price increases. In a case like this, Morgan Stanley is assuming the price hike could be 25% in FY27 and 10% in FY28. If this were to happen, volumes would decline 6% in FY27 and marginally in FY28, and on an FY26 to 28 CAGR basis, cigarette EBIT will fall 10% with a higher decline in FY27 but some recovery back in FY28. When all of this takes place, the stock implication that Morgan Stanley is estimating is FY28 EPS will remain marginally below FY26 levels and PE multiples will revert towards the 5 to 10 year average of 22 times. Remember this number, 22 times, which implies a 10 to 15% upside from this current stock price. So not bad a situation for ITC to consider. Let's look at situation number 2, where ITC passes through the full tax impact and protects its net realization per stick. When this happens, because they're passing on the entire tax impact, the volumes are expected to fall 10% in FY27 but recover partly in FY28. The FY26 to FY28 cigarette EBIT CAGR will remain flat, and the stock implication if all of this plays out will be that ITC will deliver an FY26 to 28 EPS CAGR of 4% and PE multiples improve to 3-year average of 24 times. Remember, the previous scenario was 22, this is 24 times, then that implies a 40% stock upside from the current market price. So seems like the best option for ITC to undertake right now. On the flip side, let's also evaluate the third scenario where ITC takes minimal incremental price increases, prioritizes volume over its pricing. In a case like this, the realization per stick is expected to drop 30%, cigarette EBIT will decline 23% over FY26 to FY28, and the stock implication if that plays out will be lower realization leading to FY26 to 28 EPS CAGR decline of 12%, multiples at 19%. So case 1 was 22, case 2 24, and now we're talking about 19% multiples, implying a 15 to 20% downside to the current stock price. So not a scenario that ITC should ideally be considering. Lastly, to just sum it up, the acceptance of higher prices is going to be very important via the consumers. Full effect of the tax increase will become more visible in Q1 of FY27. So we'll be waiting and watching which of these three scenarios ITC undertakes to combat this tax price hike. The current strategy of taking staggered price increases while minimizing impact on volumes and also managing market share that ITC is doing right now seems positive, and this approach may lead to a greater impact on near-term earnings is the deep water on the other side. So either way, it's not going to be it's not going to be an easy road ahead for ITC, but scenario number 2 where we spoke about passing on the entire tax hike seems like the most optimal for that stock right now.